The current price for Plug Power Inc. is hovering at $2.11 per share, reflecting a strong intraday movement that saw the stock climb nearly 9.9% in the last session. The overall market is recognizing this significant move, but the real story, the one that the casual investor often misses when they simply look at a percentage gain, is the critical, existential reason behind this spike. It's not just a general lift in clean energy stocks. It's a direct consequence of the company's aggressive and, frankly, risky financial engineering moves to secure its liquidity. Specifically, the recent announcement of a $375 million convertible senior notes offering, coupled with the payoff of a portion of its existing high-interest secured debentures, provides a substantial, albeit temporary, breathing room. This is the unexpected reality, a massive upward move driven not by a new customer contract or a significant revenue beat, but by successfully restructuring its debt to avoid a near-term financial squeeze. This complex financial maneuver is what's truly driving the momentum, and it's a necessary tension point to understand before we move further. The general market expectation for Plug Power, the narrative that dominates retail discussions and mainstream media headlines, is still tied to the long-term, speculative promise of the green hydrogen economy. It's seen as a pure-play bet on a future where hydrogen fuels everything from forklifts to data centers, and the company's vision of building a vertically integrated hydrogen ecosystem is compelling on paper. People latch on to the potential for massive scale and the idea that Plug Power will be the Amazon of hydrogen, owning the entire supply chain from production to delivery. They look at the long-term charts and remember the stock being well over $70 a share back in 2000. And $70 is the dream, but the reality right now is that the stock is trading in the low $2 range. That's the disconnect we have to address. The market is trading the company's survival and current execution, not its 20-year vision. The massive volume we saw, well over 100 million shares in a single session, points to a battle between short-term traders reacting to the financing news and long-term hopefuls trying to establish a discounted position. Let's dissect the recent stock movement. The stock had dipped below $2, a psychologically important threshold, signaling deep investor distress and increasing the pressure from both a market sentiment and a liquidity standpoint. The bounce back, powered by the convertible note offering, is essentially a sigh of relief. The $375 million raise and the subsequent use of a significant portion of those proceeds to pay down the 15.00% secured debentures, which carried an incredibly high interest rate, is a critical step in reducing the immediate burden on the company's balance sheet. This isn't just about cash flow, it's about managing perception and avoiding a catastrophic default scenario that was becoming a very real possibility, as indicated by previous disclosures about a going concern risk. Institutional investors, who have been net sellers in the past quarters as the fundamentals continued to disappoint, will view this as a necessary, if dilutive, stabilization measure. However, it's a temporary fix, essentially trading future potential dilution for immediate financial security. The convertible nature of the notes and the possibility of share conversion at a higher price down the line means the share count will almost certainly increase, continuing a pattern of dilution that has plagued long-term holders. Speaking of institutional activity, filings show an interesting mix as funds like Legal & General Group have recently acquired a significant number of shares, which suggests that some major institutions are either averaging down or betting that the recent financing secures the company long enough for their long-term hydrogen thesis to materialize. This contrarian institutional buying acts as a fundamental floor for the stock, challenging the deeply pessimistic retail narrative. The tension here is between the smart money funds who can absorb the dilution and wait for a subsidized green hydrogen future, and the everyday investor who is trading on weekly price movements and earnings misses. The company's recent participation in an Asia-Pacific investor conference, highlighting their global expansion strategy, is another attempt to shift the focus back to future growth. But without stronger fundamental results, those promises remain discounted by the market. Now, let's address the elephant in the room for a stock with this level of volatility and a share price in the low single digits: the short-selling community. Plug Power is heavily targeted. The most recent short interest data available shows an exceptionally high level of short activity, with over 305 million shares sold short. This represents a short interest percentage of float well above 23%, which is considered a massive overhang. The days to cover ratio is sitting around 4, which is also relatively high and indicates that it would take several days of average trading volume for short sellers to buy back all the shares they need to cover their positions. This combination is what creates the potential for a short squeeze, the expectation that drives a lot of the discussion on forums like Reddit and X. For an investor, understanding this is actionable. The high short interest is the reality, and it means two things. First, a large group of sophisticated players believes the stock is fundamentally overvalued or on the path to continued financial distress. Their thesis is simple: sustained losses, high cash burn, continuous dilution, and the slow, expensive build-out of hydrogen infrastructure. Second, it means that any significant positive news or even a debt refinancing event like the one we just saw can force these short sellers to cover their positions quickly, resulting in a rapid, violent upward price movement, the short squeeze. The recent jump in the stock price is likely a direct result of some short covering as the risk profile shifted immediately following the financing announcement. The borrow rates, while still relatively low, can spike rapidly if more institutional lenders recall their shares or if demand to short increases further. Retail investors should check sites that aggregate short data weekly, focusing on changes in the short interest percentage and the days to cover ratio, as these are the true indicators of short squeeze fuel, rather than chasing a pump on a volatile day. It is crucial to remember the high risk associated with chasing short squeezes. They are fleeting, and the underlying fundamental issues usually reassert themselves quickly. The core business model of Plug Power focuses on the entire green hydrogen ecosystem. They provide hydrogen fuel cell systems, known as GenDrive, for electric mobility, primarily in the material handling market. Think forklifts in distribution centers. This is where they built their initial customer base. Beyond that, they are building out the infrastructure: electrolyzers for green hydrogen production, liquefaction and cryogenics for distribution, and even stationary power generation. The expectation is that this vertical integration will eventually lead to lower production costs and higher margins as the scale increases. The reality is that the company is still deep in the capital-intensive phase of this build-out, requiring constant cash injections, which is why the convertible note offering was so necessary. They have not yet achieved the scale where the unit economics of green hydrogen truly work without significant government subsidies or high customer costs. The Q3 2025 financial highlights showed a mixed picture, with negative margins persisting despite some growth in certain revenue segments. This is the persistent tension. The vision is clear and vast, but the execution is costly and cash-intensive. The future outlook depends almost entirely on two things: successfully commissioning their key green hydrogen production plants and the continued flow of government support, specifically the hydrogen production tax credits from the Inflation Reduction Act. The commissioning of new hydrogen plants in Georgia and New York is supposed to be the inflection point, finally delivering cheaper, captive green hydrogen to their customers, which should help shift the gross margin from deeply negative towards parity. That is the catalyst the market is waiting for. If those plants come online on time and at capacity, and the tax credits flow smoothly, the stock could stabilize and begin to reflect its long-term growth potential. The risk, of course, is any further operational delays, which are common in major infrastructure projects, or any unfavorable policy changes. For investors, the next two quarterly reports are not just about revenue. They are about tangible, demonstrable progress on these large-scale infrastructure projects. To reinforce the engagement, I must ask you, the viewers, a direct question about this speculative environment. What's your take on the rising short interest in Plug Power? Do you view it as smart money correctly identifying a flawed business model? Or do you see it as a coordinated move to push fear and suppress the stock price before the hydrogen infrastructure truly comes online? Comment below and tell me if you are holding, buying, or selling Plug right now. The core insight here is that the recent stock surge, which appears to exceed the market's recent expectations, isn't a signal of a sudden fundamental turnaround, but a tactical financial maneuver to buy the company more time. The expectation is a slow, gradual buildup to the hydrogen economy. The reality is a high-stakes, volatile battle